You don't have to be the active investor guy. It's totally cool to be the passive one.
A lot of people, myself included, I actually thought the only way to get into real estate was to be active. Not many people know that there is the opportunity to invest passively.
Is you put 100K into a deal and the deal pays out 10 grand a month, for argument's sake. Normally you'd pay taxes on that. You pay capital gains on that. Now the good news is the capital gains on that money you're making is going to be lower than your W-2.
Welcome back to the Peak Profits Podcast. Today's guest is JP Albano, a seasoned entrepreneur, real estate investor, and former enterprise B2B sales executive. Over 14 years, JP closed more than $220 million in sales before walking away from the grind and to co-found a vertically integrated multifamily firm with over 700 units and $60 million in AUM. Now his mission is clear: help high-income tech professionals escape the W-2 trap and build long-lasting wealth through strategic apartment investing. He's also the host of Lessons Around podcast, a soon-to-be published author, and a father of 3 daughters, and an absolute BMW enthusiast. JP, thanks for coming on the show.
Thank you, gentlemen. Glad to be here.
It is a pleasure to be here with you. BMW enthusiast. I had a Mercedes, and so do you clash with the Mercedes versus BMW?
Yeah, it's like the what's the Jets and the they have that street gang vibe going on. No, not really. I mean, I look at it this way. There just happens to be a really, really strong BMW community or community of BMW enthusiasts.
Yeah.
It's probably one of the strongest automotive groups there is. Porsche would probably be the second one below that. I just don't really run into like a big Mercedes. They're there. There's some really cool cars. I love the 80s and the 80s versions of the cars. But yeah, there's no hate. Like if you love a car, you love a car. We all have our things that we can find common ground on.
Well, on that note, I don't know how you find the time because you clearly do a lot of things outside of that. So would love to get into your story. It sounds like your background is very similar to Chris's and I's, both in tech sales. Both have done well in tech sales over the last decade, but also have spent a lot of time in the real estate space for the last decade, investing in deals. And, our journeys are a little bit different, but would love to kind of unravel and go back to your time in tech sales. And then obviously you did very well for yourself there. What was that transition like getting and stepping into the real estate world?
Yeah. So I think it helps if I kind of start at the beginning of what forced me to get into the real estate world. So, working in tech sales as an engineer. Before even tech sales, I was an engineer. I was a sysadmin guy. I did IT. I was kind of thrusted into a pre-sales opportunity and then stumbled into sales. Like many sellers that come from that realm, I never imagined growing up one day to be a sales guy. And I think that's a good thing because I had my own preconceived notions on it. But, kind of fast forward to the catalyst, you start making, you can, if you're good, and you sell a product that's really good in the marketplace, and even if you're bad, you sell a good product in the marketplace, you can make some really good money in tech sales or sales period. So I started making more money, which is awesome. The problem that comes along with making more money after a certain point, right? Like if you're making between 100 and 200 grand, it's not that bad, is the taxes. When you start making north of 300 grand, the tax sting really becomes a thing. And you go from a world of what are people complaining about to oh, that's what they're talking about. That's why they're all about how do I minimize my taxes. So I found myself having the really good problem of seeing a lot of my income going out the window in taxes. And it forced me to realize or figure out how do I solve this problem? Because number one, I didn't want to keep working to pay the IRS. And I went down a journey. And I thought I learned that, earning money as a W-2 employee is kind of the worst thing, right? There's not a lot of tax benefits that you can do. Yeah, you can do write-offs and you can put money in your 401k, but it doesn't really move the needle. And I learned that the real secret is to make money through capital gains. So things like investing in the stock market or real estate, right? And I thought I was going to be a day trader. So I signed up to do a day trading course. I learned how to read candle charts and I wasted a bunch of money and spent a bunch of time and lost money. But going through that process, I realized, man, day trading sucks. It's really stressful, more stressful than sales. That's not what I want to do. And the light bulb went, on for me. I realized I don't want to keep selling hard drives for the rest of my life, or I don't want to day trade to make income. And I went down the path of learning more about capital gains and realizing, real estate is a way that you can do that, and specifically passive real estate in apartments. Oh, that checks the boxes. And this being a real estate investor, there's like so many different ways that you can get involved in real estate, right? You can do wholesaling, fix and flips, mobile home parks, self-storage. The list goes on and on and on. And for me, the thing that I resonated the most when I started doing this 8 or 9 years ago was apartments. Apartments just made all the sense to me. And so I went full headlong in learning and immersing myself in the apartment world. And that's sort of the origin story for that. There's more there, but that's how I got started. And that's what kind of led me down this path. But yeah, I had to have the pain first to just try to find a way to solve that.
I love to hear that you came from more of a solutions background, JP. That's literally exactly my same journey. Did some solution consulting myself. Also did the pretending I could be a day trader and thinking I knew how to options trade, which did not work very, very well. I was just sharing that
Yeah.
I went through a similar journey, thought I could day trade. That didn't go very, very well either. But I do want to really kind of bring it back to where you're talking about like your focus on capital gains. Like what was it that as you moved and you started earning that money, like what were the first steps you took to really educate yourself around understanding taxes, understanding that capital gains tax was really a lucrative way to reduce your taxable burden? Like help us understand that journey.
Yeah, I'll be honest. In the beginning, it was kind of surface level. It was like, this is the thing that you have to do, right? I.e., shift your income streams from solely just U2 into start making income streams under capital gains. So, I mean, I realized early on that that wasn't going to be an overnight thing. Like tomorrow, the next day, suddenly all of my income was now morphed into passive income, right? But I saw the path and I saw the destination to get to. Cool. If I start investing in real estate deals, I can start building these income streams and over time get to a point where, I don't know, a portion of my income from sales is offset with money through capital gains. And I think in the early days, because I was drinking through the fire hose of just learning multifamily, like there's so much there depending on what kind of investor you want to be. I decided to be an active investor. But like, yes, there is like learning how to like look at a deal, but then there's also raising capital, underwriting, operating a property, investor relations, market, like just all this stuff you got to do. So becoming really well versed on the tax world wasn't really a priority. And that really didn't come until more recently when I shifted into focusing more on how do I tell my story? How do I share what I learned about we do tax trap, shifting money into capital gains, and being able to articulate that to other sellers that I work with. And so that's where I had to hone on my skills, interview CPAs to make sure that I understood the talking points that when my CPA does the taxes, like I don't see those things, right? But now I need to be conversant enough to be able to walk someone through that, but also realize, hey, I'm not a CPA. I don't give tax advice. I'm not a tax attorney, consult a professional sort of thing, right? But it definitely was a journey because I don't think anyone ever wakes up going, you know what I want to do today? I want to learn about how capital gains works. I mean, unless you're a nerd and you're like in accounting, but I think for most normal people, mortals, it's not a thing you want to learn until you have to learn it for some reason, right? Livelihood depends on it, or I don't know, it's just required.
Thank you for sharing that. What I wanted to go back to and what was I thinking about when you were sharing your story is what did it look like to first step into real estate? You know, a lot of people have that moment where they're like, all right, I don't want to work a W 2 my whole life. I don't want to make earned income 40, 50 hours a week, give 40% away on taxes. You first had that thought, then you decided, let me try day trading, let me try doing other things. You just landed on real estate. What did that look like? Did you invest in a passive deal? Did you buy your own rental
Yeah, I'll
property?
explain
Can
that.
you talk through that?
Yeah, absolutely. The journey in the beginning. So looking back, it makes more sense now, but I had a hard time with this. I recently learned that the way I learn things, I have to like surround myself with all aspects of things. It's good and bad. There's a lot of analysis paralysis. In the beginning, it was even worse. So when I realized, okay, multifamily made sense, I want to do that. There at the time in 2017, 2018, there really wasn't a lot of resources. I mean, there were, but not a lot of resources to help you with. I mean, the biggest struggle that I had was like learning how to underwrite. Like there was no course on that. It was you had to join, you had to know someone that knew someone that knew someone to pay $100,000 for a mastermind, have someone show you that sort of thing. That's how like elusive it was. So for me, the first thing that I stumbled upon a group that they had a program going on where they were inviting investors to be KPs, key principals, basically co-sign along with them. And along with doing that, you get to use the street cred, because that was really important, like having the street cred to tell brokers that you're on a deal. So my first deal I did was like a 42 unit, not like it was a 42 unit in Houston, Texas. That was a value add deal. I think I invested like 75K into that deal. And I got some exposure to some of the inner workings of like what happens in value add things, but that wasn't enough. And somewhere along the line in the beginning, I went from thinking I was going to be a passive apartment investor. And then what I found was I really liked the doing part of it. Um, Looking back, I probably would have stayed a passive investor, but that's neither here nor there. So I went in with the idea of being a passive one. And then I realized that when I was talking to brokers and people in the industry, I love the energy. I love the how most people are like always looking for ways to add value and to partner with you. And I think I had at the point in time I was at a low point in my sales career where I just felt like, working for a reseller, it's a really interesting place to work. Like you're not a manufacturer, you're not an end user, you're in the middle somewhere. And so you're going to have to like defend both sides, customers and the manufacturer reps, right? No offense. So like there was a bit of a reprieve going into the real estate industry where people were more open to working with you and collaborative. And it was like a breath of fresh air. And so I think that's what further incentivized me or made me realize, hey, maybe I should just focus on really trying to be more active in the real estate world. And so first job was basically being a passive investor in a deal. And the second deal that we did, that same group helped put together a handful of guys together. And we syndicated our first deal by ourselves. I wouldn't recommend that for a newbie, but we did a $2 million 28 unit apartment unit or complex rather in Texas, Houston, Texas as well. And that was our second deal, but my first like real active real estate deal.
I love the fact that you talk about the passive versus active, because I think a lot of people, myself included, I actually thought the only way to get into real estate was to be active within it. Not many people know that there is the opportunity to invest passively. So can you talk about your journey of that initial passive investment? Like what did you do to identify that group were the right group? What did the materials that you had to review look like? You mentioned that there was nothing around underwriting for you to learn that. So how did you actually validate the deal? How did you know that it was a good deal? How did you know that that was where you wanted to put your 75K?
All great questions. All great questions, Chris. So if I go back in time, this group had put on a handful of presentations, webinars. They had a good enough reputation from what I can tell. They had a handful of investors that they had worked with in the past. They were saying and doing all the right things for me. I didn't, truthfully, I didn't really have a lot of things to kind of validate stuff off of. At some point, you do have to take a leap of faith and do something because that's how you learn. You could think and play with, but until you sign the thing and wire the money and go through that whole experience over a period of time, years, that you do learn. That's what that's like. Oh, when you don't get communications from the sponsors, that's what that feels like. Or that's what they mean by, cash on cash return or the IRR. That's what K1 is. And that's what, like all those things make sense initially, but then they really make sense when you go to experience that. Like I'll give you an example, like, what's a good use case? Cap rates. So I understood cap rates early on as like, okay, I understand principally how this works, but I didn't really understand it, if that makes sense. And it wasn't until I was in a position where I was buying a property or even selling a property, being on both sides of the coin, you really have an appreciation of what cap rate is. And just for the audience, cap rate is short for capitalization rate. If you were to buy a property for all cash, what would the ROI be on it? So for example, if you bought it in all cash and it printed out enough cash flow for you, and the cap rate is 4%, you're making a 4% annual return, right? And the lower the cap rate, there's this weird inverse relationship where it's better because you get higher leverage on it, but it doesn't make a lot of sense. And I won't go into the rabbit hole of that. But anyway, that was an example of just you hear a concept, read about a concept, but it really isn't until you put that concept into practice by either being a passive investor or an active investor, does it really make a lot of sense. And then I think it's a lot easier today to kind of round up the question. It's a lot easier today to learn some of these things because there's so many more groups, there's so many more people information sharing about underwriting, which is one of the most important things. But there's a lot to know. And I think if I can kind of go back to, a younger version of myself, it's like you don't have to be the active investor guy. It's totally cool to be the passive one. You can essentially trade one job for the next one, and you got to be careful about that if you're not really intentional about what you're doing.
Yeah, you hit on a lot of things there that I liked and I want to unpack because both the passive and active side, but you talked earlier about the analysis paralysis and, looking through everything, like being on bigger pockets or reading 10 books about investing or listening to every podcast on your way to and from work. That's all well and good and will give you some information to be familiar with terminology and how things work. But until you do it, like you're saying, you don't really know. And that's where you learn by far the most, right? Investing in a deal, signing subscription docs on the PPM, wiring capital, starting to get distributions, starting to get that monthly reporting, looking through the P&L, getting your first K1, right? Like that stuff where I talk to people every week, they want to get involved. Maybe they've been looking at deals, they're getting involved in real estate for 3 years, but have yet to pull a trigger and they're trying to figure out what path is right for them. If you don't have 100K to start, invest $25,000 into your first deal, right? Get exposure to something to really understand, is this the path I want to go, right? Most people that are doing well in tech sales or making a couple 100,000 can invest $25,000 into a deal to get exposure to see if this is the path that they want to continue to go down, or if they just want to be more hands off and, set it and forget it in the market, for the next 30 years. So I think that's important to discuss and understand as an investor if you're really debating getting into the real estate space and whether you want to one take that active or passive route, and if you want to be a little more hands off because you have a family at home and you have a demanding job, start to really do your due diligence but get into a deal once you feel that you're in position to do so. I think that stuff's really important. And so what you do today now, I want to fast forward a little bit, you really help other tech professionals invest into to deals as well. Can you talk a little bit about what you're focusing on today? Are you buying new deals? Are you raising capital? What are you doing today to help others get exposure to real estate?
Yeah. So that's it. There was one problem that I ran into when I was actively looking for new deals to do a number of years ago. And the thing I kind of failed to do early on enough of, and probably a good enough job with, was the marketing side and bringing in new investors. And, we hit a point as a group where we couldn't raise money we were relying on other people to bring in money for us. And that's cool, but it's nice to be master of your own domains. About 2 or 3 years ago, I had the realization, okay, I got to learn how to do this, and made the decision and kind of morphed along the way of really focusing on how do I focus on marketing, spread the message, and find ways to help other high income earning sellers put their money to work and tell the story, right? And so what we've been doing the last year and a half now, 2 years, a year and a half, is helping allocate capital from busy high earning sellers into best in class operators deals. So said another way, we find really good operators that operate in real estate, could be mobile home parks, self-storage, apartments, whatever. We find them, we go through their deals, and then we notify investors in our network, hey, we've got a great deal that we want to invest in. Do you want to be part of this? And we help allocate capital. We put capital in there, put it to work. So like the new direction for me is to wind down our existing real estate assets, no longer do active operator dude anymore, and just focus on being a passive investor. Take the experience that we've gained over the last 8 years or so and put it to work in passive deals in all different types of asset classes outside of just apartments, for example.
And with that, JP, you mentioned some kind of terminology that people need to go in and learn. You mentioned cap rates. There's a lot of other terminology like IRR, equity multiples, cash on cash. As someone who speaks sales and investing, like how would you simplify what all of those different terms may or may not mean, but also which would you say investors should look at as a level of priority?
Yep. Yep. That's a good question. That's a good question. Yeah, you're right. Because I think at the end of the day, right, as an investor, when you're analyzing a deal to move forward with, it's easy to get overwhelmed with all of the stuff, right? When you get presented a deal, there's going to be an IRR, an internal rate of return. There's going to be cash on cash. There's going to be equity multiple and with an X after a number. There's a lot of things there. And I think me personally speaking, think that like my deal buy box is looking at deals that are going to be close to a doubling of your money in 3 to 5 years. So if that works out to be an average of 18% ish average annual return, I'm happy with that. Another good metric to use is internal rate of return. I'll attempt to explain that in a very simplistic way. But looking at IRRs that are in the high teens, I think is also a good checkbox, right? If it's low teens, stay away. If it's high teens, that's better use of your money. So IRR, it's a calculation where, let's say you have a deal that runs for 4 years, argument's sake. They run a calculation where you calculate, I put money in, and I'm going to calculate what your return is based on the start date, the end date, and the times in which I'm going to get returns back. So for example, if it takes me 3.5 years of the 4 years to get some return, that impacts the overall IRR number. But if I get money, day one that I'm getting, distributions on, that's going to positively impact that IRR number. So it's a calculation that takes all of this into the amount of returns you get, the frequency of them, the size of it, all goes into this whole equation to give you a number. And it's a really good metric to use because you can really, on face value, compare two deals versus another. Would you guys agree or disagree with me on that one?
Yeah,
I agree with everything.
yeah, I agree because it really takes into the account the time value of money, right?
Value.
So if you're investing in a deal where your whole return is based on exiting the asset in 5
The very
years,
end. Yeah,
right? Then yeah, you're just waiting and your capital is just sitting until you get that hopefully large profit versus
100%.
strong cash flowing deal now is going to be better from an IRR perspective.
100%. So yeah, and that's going back to our earlier conversation. IRR was a conceptual thing that didn't really make a lot of sense until I had to build IRR calculations or build an underwriting model that had that in there. And then you really, when you build your own spreadsheet model, you really have a deeper understanding of how the math works and a deeper appreciation. And then you could kind of speak about it. So yeah, for a new investor, IRR is a great thing to learn and start from. And it's a really great way that you can use as your evaluation tool. Like if there's nothing else, you can look at IRRs and compare deals. And that should give you some really good guidance on direction.
Yeah, that's great information to know. As a new investor, many times when you're seeing all these marketing slicks, it can get overwhelming at times with all these
Of course.
abbreviations and return metrics and numbers and spreadsheets and everything. So to try to simplify it in a way that you're really looking at things that are important, but also easily to understand and compare against different opportunities. And with that said, numbers aside, you'll see a lot of decks that fall in between that low teens, like you said, to that 18, right? 13 to 18.
Well, let's talk about that for a quick second because I've experienced this early on. Bryan, you're mentioning like a lot of slide materials or presentation materials will show very similar internal rates of return, right? 15, 16, 17, 18, whatever. And I don't know about you, but I've noticed you won't really see many opportunities that have like 30% IRR or 40% IRR. Now, we know they're there, right? But what I've learned is like, well, if you show that IRR, everyone thinks that you're full of crap and it's a scam or you got to run away. So like, it's like the industry has hurt itself from being able to showcase really potentially lucrative deals because people will otherwise just assume that that's just too good to be true and not possible. You and I know we've either it's our own deals or someone else's deal where they just crushed it, like right timing, right everything, and they were able to kill it, and the IRRs were sky high. But like that's another thing too that I think you gain as experience in really understanding, are things really tapered down for the sake of just seeming really, really conservative, or is there really, really a massive upside here that I'm not?
Right. Yeah, and it goes into like how aggressive is the underwriting deck here. And as you become, not just investor 1.0 and trying to understand some of the concepts, but investor 2.0, 3.0 in these deals is where's the risk associated with what they're trying to project here? And what's the business plan that's going into these projections and how accessible is it to get to a 15? I'll take a 15 all day if it's risk mitigated and there's really a lot of backstops in the financing, and the backstops in place are really solid. The multiple extra strategies, and versus we're really being aggressive on our rent assumptions here, or we're growing 7% a year in a market that's flat right now, right? So there's a lot that kind of goes into it as you start to dissect and look at more. That kind
That's
of
right.
leads me into my next question, which would be, you mentioned allocating capital now, potentially in other asset classes. How are you identifying good operators? I think at the end of the day, operators start to become close to the top before you look at all that stuff. You're investing with an operator, you're investing with people that are running this deal, and you're in a partnership with them for 5 years or 7 years or 3 years,
Getting married. You're getting
right?
married.
So I think more important, above all the numbers that you see in a spreadsheet, how are you determining relationships, operators, track record, and who you're investing in?
Yeah, it's a challenging thing. If I kind of distill it down to some core elements, it is track record, right? So to in my mind, to be best in class, like at a minimum, you should have round tripped at least 5 or 10 deals of the same asset class, right? So for example, what would not be acceptable is you're an apartment guy and then one day you decide you want to be a self-storage guy. And this is your first self-storage or second self-storage deal. No, come back later on. So I want to see lots of round trips, and round trip, like talk about jargon. Round
Full
trip is where
cycle.
full cycle. You bought a deal, you did your work, and you sold it successfully for more money than you made. Right, that is a round trip. So at least 5 to 10 of those with like strong returns, like you were able to hit your numbers on there. I like to see groups that have some level of vertical integration in their organization. There's levels of extreme that you can go with that, right? But I like seeing that some vertical integration there. I like well-funded sponsors, like they've got really good liquidity, really good cash reserves, and they're putting more than the minimum, more than the bank minimum into a deal. So for those that don't know, when you co-sign on a loan, the bank wants the operator, the sponsor, to put their own cash in the deal, right? And that's usually 10% minimum. And there's ways you get around it. You could have the operator LLC go in there, and then you pull in your friends in there. There's all these different ways that you can do, but I want to see that they're actually putting their cash in the deal, not like, the whatever partners in the project. And then seeing that they have traction in that particular market. That makes you feel comfortable at night. Really good. And then like pre-sale stuff, like really good responsiveness, good communication ability, right? Like they have frequent newsletters that go out, updates about the deal itself. And I like deals that honestly cash flow relatively quickly. So in the first 3 months, maybe most 6 months, I want to start seeing cash flows. If it's not cash flowing, I'm no longer interested in it.
And would you say, JP, that that's like those are your minimum requirements for every single deal? If it can't tick those, you mentioned your buy box earlier. If it can't tick those, you're just categorically not going to look through the business case. Like that's really your starting metric of
There's so many deals out there. There's so many deals. Like you can be picky. Be picky. It's funny. It's fun being on the other side of this game now, right? Where I went from being the guy that was like, I have this amazing deal. You want to invest in it? Please give me your money. To like, oh, this is what it's like to be the equity group. Yeah, send me your deal room. I'll look through it. Maybe next week. I got a lot of crap going on. So it's a better position to be in. And yeah, I think it makes sense, especially in this day and age. There's so many opportunities, real estate or otherwise, that just like be picky with your money. But don't be too picky that you don't do anything, but be picky.
I think though that it's a really important thing to share, right? Is like you have a set of criteria, and before you even engage beyond that, looking at the business case, looking at the underwriting, right? You're really looking into the operator.
Yeah,
Because
you're
at the end
wasting
of
your time otherwise. Like if you can't show me that you've done 10 other deals like this with really good returns, okay, cool. Vertically integrated, you got some cool, that's good. Okay, now we can start talking. It's like the table stakes before you get to the next.
and you've done this for yourself and ultimately for other investors as well, which is kind of helping them with their tax strategies, right? Like what are some of the most common tax strategies that people either miss, forget, or maybe just aren't aware of that investing in multifamily or other real estate can help them with?
It's a good question. I'll put my CPA hat on. So again, not a tax professional, but
I'm
like
really grilling you on the tax
I
stuff
know,
today.
I know. So like I think for new investors, one of the new things. So like again, I'll be honest. and I know you know this, there is no magic thing that you can do. There's no thing that I'm going to put on my 1040 this year that if I fill out line 17 on page 37, section B, if I put this thing there, suddenly my taxes shift. Or like when my commission check comes in next quarter, like magically there's more available money for me. Doesn't work like that. And I'm not saying you're saying that, but I just want to dispel any myths about this. It's like this slow thing. You'll see this later on, not this tax year, maybe next tax year, maybe the tax year after that. But basically the biggest things are depreciation. Depreciation that now, thankfully, Trump brought back bonus depreciation. It's awesome. And what that means is you're able to take a paper loss on investments that you make in your real estate deal. So a simple example I like to use is you put 100K into a deal. Normally, if you start making money on that, like the deal pays out 10 grand a month, for argument's sake. Normally, you'd pay taxes on that. You pay capital gains on that. Now, the good news is the capital gains on that money you're making is going to be lower than your W-2, usually max of 20% versus up to 37% if you're on a high earner, right? So that's kind of part number one. But what you can do in real estate that you can't do really in other W-2 is you can say, look, I bought this building. It's freaking old, or I'm going to do a lot of repairs on it, and I want to write off the money that I'm spending on it, and I want to take that as a loss. So the IRS allows you to do that. So I put 100K in, maybe I can take a 100K of loss. That's possible. It's entirely possible. So that means that before I start paying any taxes on money I make from this apartment, this project, I got a negative $100,000. So I got to make 100 grand first to dig us out of the hole. And then when I make that first dollar after the 100 grand, then I would start potentially paying capital gains taxes on it. Now, I will be careful. There's depreciation recapture and some other crap that will sneak up on you. So it's not all free cake, right? There is stuff. But the point here is there is like 45 different tax mitigation strategies that a well-versed CPA or accountant that knows what the hell they're doing can do with that money that you make in real estate that you just don't have available to you when you're a W-2 earner. And that's really the bottom line. Would you agree?
Yeah. I mean, it sounds
Somewhere in
like
the
you're a
middle?
CPA today, honestly. No, that's good stuff. Yeah, I think there's a slight misconception with people that aren't as well versed in the industry, thinking that they can invest in real estate and then miraculously save, W-2 active income taxes
I
and
wish there is a way. There is one way. There
there
is,
is. Yep.
from what I understand. Actually, is that true? Okay. I'm learning new stuff, like literally real time. Like I was talking with a life insurance friend of mine, because I believe in life insurance too. That's a whole animal in itself. And I'm trying to put together a program, a package around these alternative tax strategies that actually allow you to do things with high W-2 income, uh, to stock income, where you can potentially write off a 5-to-1 ratio of money. So you put in 100 grand into one of these projects, and you're able to deduct $500,000 from your W-2. So your taxable income goes from whatever it was to that, right? That's a whole thing I'm exploring. So those things do exist. But the big misconception is, yes, you invest in real estate, and I put the 100 grand in the deal. Now I've got 100 grand of depreciation. I'm going to mark that off the 300K that I just made in tech sales, right? You can't do that unless you happen to qualify for real estate professional status, which is a whole rabbit hole in itself. But the other normal way of doing this is actually investing in oil and gas. So if you invest in oil and gas, that wild card that you get from that investment, you are able to apply that, from what I remember, to W-2 and also some other types of income that you can get as well. So, and there might be one other one that you can do that with, but
Yeah.
it's a specialized, nuanced thing.
Yeah, with the oil and gas, we've been a little bit versed in that as well. And there's a couple different avenues within oil and gas. And one is existing wells or drilling
Uh-huh.
for new wells. So typically,
Yes.
drilling for new wells allows you to depreciate against active income, but
Okay.
it is far riskier. Like, you better be
Yes.
ready to lose the capital you invested for the
Yep.
depreciation you're getting, or you're investing in existing wells that you already know exist, obviously, and they're producing some type of flow. And now it's producing some type of income, but you're not allowed to now take that, from my understanding, and offset your active income. The only other way that I will note is the short term rental loophole. If you buy an Airbnb and you rent it out for 7 days or less on average, and you manage it yourself more than 100 hours that year, the IRS looks at that as a hotel business. You are running an active hotel. So then you can do a cost segregation study on that Airbnb for the price of the property that you paid in year one and offset your active income. Now that just kind of gets into the nuances of, do you want to buy an Airbnb? Do you want to manage it
You
yourself?
just
Do you
you
want to
just
do
told
all?
me about a job, so I'm going to save 60 grand on taxes, but I just
Correct.
like worked for free for $60,000. It just cost me that. So like,
Exactly, which I have not gone that route for that exact reason. I just don't have the time or want to do that. But yes, those are the
brain
ways
dead.
to offset active income. So I'll just keep my depreciation on the passive
Yeah.
side, continue to
Yeah, man.
invest with
Yep.
operators and deals that I
And
really like.
you can carry it forward too. Like if you can't use all that depreciation that you've got, you're able to kind of carry it to the next years. The bottom line is, I think we all agree, is like there's just so much more optionality that you have when you are investing in real estate and making your money with that. There's just like you've got your back isn't against the wall. Period. End of story.
And so with that, JP, why multifamily? Like, is that still something that you're looking into? Are there still multifamily deals? You mentioned self-storage a few times. You mentioned our home parks. Like, what's your overall outlook on the market?
Thoughts on that one. So in the beginning, for me, I just resonated with the idea of like housing makes sense. I like that. Specifically, I liked having more units from a risk mitigation standpoint, like 100 units versus 2 units. Have 100 people paying my mortgage. That just makes sense to me. So I love that. I think certain types of asset classes in multifamily make sense. Having gone through this longer and spent a lot of time in D class and C class properties, I'm like an A minus guy all day long now, but whatever. When you get started, like you don't have those options to be able to do A class. Anyway, so I believed in the principle of what multifamily represents. Makes sense. Having lived in that world for the last 8 years and gone through all the stuff, I'm just done with the intricacies of apartments. These are families that live, people, they have lives. Can you believe they have lives? They have complicated lives. Shit goes wrong all the time. Lose a job, the car crashes, whatever. Like life happens, right? And you've got 15 or hundreds of these things going on at any point in time. There's a lot of stuff. And having run a property management business, that's like a losing proposition. So that's really hard. And I'm glad I went into the space so I can learn what I know, and that's great. Would I have picked a different asset class early on? Probably not. Whatever. Hindsight is 2020 a little bit. But moving forward, like I'm interested in the economics and the diversification from other asset classes. So yes, I did mention self-storage. I think that's like a really easy, like low risk, not a lot of moving parts business. You're buying land, you got some buildings on there. There's a garage door, there's a security camera. There's not a lot of things that go wrong with that. There's not all these families that live there, right? So that's cool. More lately, I got involved in some medical office deals. That's really cool too. You're buying these medical commercial buildings with really professional tenants in there that have these long-term leases where the tenant's responsible for all the things, insurance, maintenance, taxes, all the stuff. So that's really cool. I've done some mobile home parks. That's also interesting. I think it depends on what the mobile home park is. Is it just, do they own the pad? Do they own the actual mobile home itself? So there's some nuance there. That's kind of cool. But like my opinion and my view is there's enough room in this world to have exposure to all these different asset classes across a variety of different operators in different parts of the country. So diversify as all you can. The only problem is in the beginning is you just can't learn enough about all of these things to feel like comfortable making an investment in it. So you pick one thing, learn that until you're comfortable, and then move on to the next one. But I think that should be like a long-term goal for investors. And then I also did some private equity, which is kind of cool too. But that's a whole other animal on itself.
Yeah. No, that's great. And obviously, your journey, it seems like over the last 8 years, has now kind of grown into these other asset classes. And I think that kind of goes full circle around the avatar and the people that you're raising from as to why they go to you, right? Or, we have a similar business with 7B Capital. Is like we have the relationships with the operators. Different operators bring different deals and different markets and different opportunities, right? And they want to have a relationship with you. They trust you. They want to see how you're thinking about these opportunities. And whether it's in multifamily or other asset classes, at the end of the day, they just want really high quality private placement real estate backed deals
That's right.
exposure. right? And
Yep.
so if you can bring that to them and you start to build a relationship with your investors, then that's a win-win for both sides. And so on that point, what's next for your business as a capital allocator now? Where do you foresee closing 2025? Do you foresee yourself getting into another deal? Are you actively waiting for a deal? And what does 2026 and on look like? I know we don't have a magic 8 ball or anything. I wish we did so we can get into the best deals, but what
Yeah,
does that
man.
look like moving forward for you?
Yeah, well, I'll tell you what. I mean, 25 has been a great year. Like, I'm glad that we got out of the crap that we've been in the last 4 years. You know, with Trump coming in, I feel like a lead weight has been lifted. Things are picking up. I like the overall momentum and juju and just like culture of where things are going. So that's all good stuff. I'd love for some interest rates to drop a lot faster. It'll help me exit some of my properties, but that's neither here nor there. So as far as like 26 for the rest of this year, I've got, 2 deals that we're at least 2 more deals that we're raising for. One is that medical office thing I mentioned to you, and then I have this kind of really cool private equity thing that it's pretty badass. So that one we're kind of working on rounding out between now and the end of the year, and then next year, there'll be some more deals. I'm not sure what they look like. Well, there'll be more of what I told you, either more self storage or more medical office or whatever else. Hopefully by then I've rounded out down the rest of my real estate holdings, and I can just focus 100% on newer deals, right? That we want to be passive with. We're rebranding my book, Amazon bestseller titled "So Rich You Can Quit." It'll be rebranded to Earn More, Keep More, Keep More, Earn More. I haven't really decided on the title there. And just to expand beyond just tech sales, right? Just expand to the broader high earning sellers market. And I've got some new kind of, you know, I'm working on building out some offerings that pull in a really creative way of building wealth that leverages real estate, leverages life insurance, leverages crypto, stocks, and putting the whole thing together. That's what I'm kind of, it's like a pet project of mine right now that I'm working through. And once I kind of prove it to myself that it works, then I would like to, showcase it to the rest of the people in my circle. But that's what I'm working on. And that's what I got, focusing on for next year too.
That's amazing, JP. And where can people, number one, find your book, whether it's the currently named one, the future named, and also where can people get hold of you if they're interested in potentially investing in any of these opportunities or future opportunities that you might have?
Yeah, the book is easy. If you grab the book, you can get the book for free. Just cover shipping charges. Go to sorichucanquit.com and just hit the button, fill it out. And by virtue of doing that, you will get access to our emails for notifications about deals. Or if you want to get in touch with me, you can check out jpalbano.com or techsalesinvestorclub.com. Those are all 3 different valid domains that work. So sorichucanquit.com, jpalbano.com, or techsalesinvestorclub.com. They all work.
And we'll put all of that in the description as well, so people can quickly link to that
100%.
too. Well, we really do appreciate your time, JP. Thank you for joining us. Again, this is extremely helpful. It's always great to speak to people that have walked through the journey that we're walking through, that are continuing to walk through that journey alongside us as well. So really do appreciate your time and insight for the listeners today.
Appreciate that. Thank you so much, guys.
Thanks, JP.
Cheers.